Stocks are at all-time highs, so why is nobody happy? On paper, this should be a moment of celebration. Stock markets are hovering near all-time highs. Headlines talk about record indices, booming tech stocks, and historic wealth creation. And yet, almost nobody feels good about it, not workers, not young people, not even many of the investors who are technically winning. This disconnect between market performance and public mood is not accidental. It reveals something deeply unhealthy about the current financial system. 1. The gains are concentrated at the very top. The first and most obvious reason is who is actually benefiting. Today's stock market gains are not broadly shared. They are overwhelmingly captured by billionaires, large institutional investors, those who already own significant assets. For the majority of people, especially the middle class and younger generations, stock market highs don't translate into better lives. Wages haven't kept pace, housing is unaffordable. Healthcare, education, and basic living costs keep rising. When markets rally while everyday life gets harder, the rally feels hollow. It doesn't feel like prosperity, it feels like exclusion. A market that rises while most people fall behind doesn't inspire confidence. It breeds resentment and disbelief. 2. Even the winners know it isn't sustainable. What's more unsettling is that even many of the beneficiaries aren't celebrating. Those inside the market can see the fragility. Valuations stretch far beyond historical norms. Shein full of stocks driving most of the gains. Liquidity and speculation overpowering fundamentals. Asset prices rising faster than real economic growth. Deep down, many investors sense that this is not a healthy expansion. It feels engineered, propped up, and dependent on confidence rather than cash flows. So instead of joy, there's anxiety. People aren't asking, how high can this go? They're asking, how bad will it be when it ends? 3. Participation is no longer optional. It's forced by fear. Here is the most uncomfortable truth. Many people are in the market not because they believe in it, but because they're afraid of being left behind. This is FOMO in its most dangerous form. Investors know staying out means falling behind inflation. Cash is silently losing value. Retirement depends on asset appreciation. So they participate even when they don't trust the system. This is not optimism, it's coerced risk-taking. When people invest because they have no alternative, not because they believe in future growth, markets become psychologically unstable. 4. Stocks are rising while life is getting worse. Traditionally, strong markets signaled a strong economy. Today that relationship is broken. Stocks are rising while housing becomes unreachable. Debt burdens grow. Job security feels fragile. Inequality widens. This creates cognitive dissonance. The numbers say everything is fine, but lived experience says the opposite. When markets stop reflecting reality, trust erodes, even if prices keep going up. 5. A market without joy is a warning sign. Healthy bull markets feel different. They feel broad, inclusive, and tied to real progress. People invest with confidence, not dread. This one feels tense. It feels like everyone knows the music is still playing, but fewer chairs remain. Nobody wants to be the last one standing when it stops. That's why even record highs feel heavy rather than exciting. The bottom line: stocks are at all-time highs, but happiness is not, because the gains are concentrated. The risks are widely understood. Participation is driven by fear, not belief. And the system feels fragile, not fair. Markets don't collapse because people are pessimistic. They collapse when confidence is replaced by obligation. And right now, the rally feels less like a celebration and more like a quiet agreement to keep dancing, even though everyone knows how this story usually ends. If you find this perspective valuable, if you care about clear, honest analysis of markets, bubbles, and financial extremes, without hype or false optimism, consider subscribing to the channel. I focus on market psychology and systemic risk, why bubbles form and how they end, inequality, wealth concentration, and real-world impacts. Thinking critically when markets stop making sense. Subscribe if you want to understand markets, not just chase them.